Welcome back. You're watching Investors Guide. Dhirendra is still with us, and we're realigning the portfolios we designed for you 2 years ago. Now, the next portfolio we're going to look at is designed for someone who's 45 years old. And I want to take you through a case of Vikal, who's written in to us. Now, Vikal has been incurring losses on his portfolio. He's very worried about his investments right now, and he wants to know what he should be doing. Take a look.
Moving to a new city is never easy for a family. But a better job opportunity and a better future for his children drove Vikal Gupta to move to the big bad city of Mumbai. And as though the move wasn't difficult enough for the family, Vikal's investments are not doing as well as he would like them to.
I have been investing in mutual fund for last 15 to 18 months through SIP in approximately 10 scripts. As of now, today, I am sitting in some 15 to 20% accumulated losses, and I request kindly advise me what should I do, whether I need to continue or should I exit from these mutual funds.
With about 40,000 rupees going into his equity investments every month, Vikal cannot afford to lose any more money, and he is afraid that his choice of funds may not be right for the age bracket.
Alright, so that was Vikal. Vikal has a very strong equity portfolio, but he's a little nervous about the kind of money he's losing right now in the market. Obviously unhappy with the risk that he's taking. Would you say our stable growth portfolio, which was designed for a 45-year-old, would suit his needs better? It is something that steps back a little bit from the risk that other portfolios take, and it's showing in the results as well, isn't it?
Yes, very much so. If you are looking at growth, at the same time you want it with great stability. Of course, that's a better way of approaching it, and more so with the kind of portfolio which he has. It is 5 of the 10 funds which he has, I would like it to be dropped in the first place if I was just reviewing that portfolio. But that apart, having a portfolio where it automatically rebalances 30 to 35% into fixed income, which provides a great stability. Even if you take a look in the interim, you will not be very upset with the performance. That kind of portfolio never is on a free fall. When you see the market going down by 2% in a day, that portfolio never slips, falls that much in a brief period of time. And at the same time, you are able to reasonably participate in the growth. Not as much as an aggressive portfolio, but it will be good enough compared to any fixed income avenue. So I would say, given your temperament, the growth and stable growth portfolio will be better suited.
All right, the stable growth portfolio is a very interesting portfolio. We have 4 balanced funds in this portfolio. It makes it easier for you to manage the portfolio. It makes it easier, of course, for the rebalancing that happens, where every time the market is down, some money is moved into equity to rebalance you. Now, these are the funds that we've invested in: the DSP BlackRock Balance, the FT India Balanced Fund, Hdfc Prudence, and the Reliance Regular Savings Balance. Dhirendra, are you happy with what you're seeing on this fund right now? It is doing what we expected it to do and what we planned for it to do. So, are you still going to make some changes?
No, I would not like to make any changes here. Maybe at some point we will reduce it to 3, and it will not all affect our performance. But just because I would like to provide continuity to something which we have planned, and our principles are right, and I continue to believe in that. So I would resist my temptation to make any changes here.
All right, Vikal, that was our stable growth portfolio. I'm going to give you a quick recap: DSP BlackRock Balance, FT India Balanced Fund, Hdfc Prudence, Reliance Regular Savings Balance. 4 balanced funds making up our portfolio. Now, if you want something that's even more conservative, then that portfolio, we have one designed for you as well. This is our conservative portfolio. It's given us a return of 3%. It's meant basically to guard your capital when the market crashes, like it has in the last 3 weeks, 2 to 4 weeks. This is our conservative portfolio. We've invested in the FT India P ratio fund of fund, the Hdfc MIP, and the Reliance MIP. The portfolio is up 3.2% annualized over the last 2 years. Now, Dhirendra, given that we've invested in MIPs right now, and they're meant to beat fixed income that's currently giving in about 8 or 9%, isn't 3.2% a little unimpressive?
Not at all. I would like to carry on with this. And 3% return is not something to be very pleased about. But given the state of market, and given that we have targeted a 30% allocation to equity, it looks fairly impressive. And this once again, despite being a conservative portfolio, it is an accumulative portfolio. We are making this regular investment. So I think in 2 years time for accumulation is not long enough for you to, and these 2 years, what we have seen looks like a full cycle, because the first year we were seeing upswing, and the past 1 year since last November we have seen a significant decline. So that's why we see complete nullification of the early gains. But I would say that in 2 to 3 years time frame, with great without any interim substantial decline in value, this portfolio with a great stability can accumulate into something sizable.
The portfolio does have about 36% invested in equity, Dhirendra. Is that what we had aimed for when we designed this portfolio? Are you sure you're comfortable with the kind of equity allocation it has right now?
No, we had targeted 30% equity. But what has happened right now, particularly last month, that because of the drop in the the market's valuation, the Templeton India Dynamic P ratio fund that has increased its allocation. And I would not like to fiddle. Once I have built, once I have constructed a portfolio, there are occasions when this fund will be only 20% into equity, and there are occasions when it can go up to about 40%. And that I would like to. We have kept a very flexible variable component by way of Templeton India Dynamic P ratio fund, and that takes care of it. We don't have to intervene in this.
I want to also bring your attention to our MIPs. Now, HDFC MIP and Reliance MIP have given us close to 4.5 to 5% over the last 2 years. Now, given where our interest rates are right now, is 4.5% a little disappointing from an MIP that's supposed to beat the fixed deposit rate that we get?
Yes, my expectation from MIP will be that it should beat the fixed income rate or fixed income return by at least 30 to 40%. But we should not forget that here we have 20 to 30% allocation into equity, and equity has gone down in value. So your gains on the fixed income portfolio have been nullified, or has been neutralized by the losses in the equity portfolio. And and this portfolio has done exactly what it was expected to do, that it has not witnessed a capital erosion. And I'm hopeful that in the coming year, even if equity is not doing well, assuming that we are faced with a 10% decline in equity values even from here, still this fund, given its allocation, should be able to do little better than most MIPs.
No changes to our conservative portfolio. Quick recap on the funds we've invested in. FT India Dynamic PE Ratio Fund of Fund, that's the first one. 2 MIPs, the Reliance MIP and the HDFC MIP, designed specifically for someone who has a very short time period and also someone who's nearing retirement. Coming up after the break, we're going to talk to you about where you should be investing your money if you're already retired and you expect your money to pay you an income right now. That's after the break. Don't go anywhere.